I'm the Jolly Saver and welcome back to my channel. I've got a very exciting video today. I'm going to show you the maths behind monthly mortgage repayments. So if you're anything like me, you might wonder how mortgage providers calculate how much you need to repay monthly to pay off your mortgage. And you might wonder, why is it a difficult calculation? Surely it's just the mortgage balance divided by the number of months that you're getting the mortgage out for. Well, if we didn't have to pay interest on the mortgage, that would be true. However, it's the interest that makes it a difficult calculation, and I'll show you why. So I've set on my spreadsheet here, and I've got a mortgage balance of £100,000. So let's pretend we want to go to a bank and try and get a mortgage for £100,000, and we want to take that out over 10 years. So that would be 120 months. So if we didn't have to pay interest, the calculation would be the mortgage amount, which is £100,000, divided by the number of months that we want to repay it over. So that will give us a monthly payment of £833, and you can see how those figures work below. So I would start out with £100,000, I would repay £833 a month. As I said, this is a hypothetical situation where I'm not paying any interest, and then the balance at the end of the month, you can see in month one it would be £99,167. And if I continue doing that for the 120 months of the mortgage, you can see that this final balance is running down and down and down, and then until we get to month 120 where it finally runs down to zero. Perfect, yeah. However, it's not an ideal world, and for us to have a mortgage, the mortgage provider or bank, they charge us an interest rate on the mortgage. So let's pretend that we go to the bank and we get charged an interest rate of 1% per year. So I'll stick with that monthly payment, but I'll show what impact that interest has on it. So although we would be having a fixed monthly repayment of £833, the interest varies month on month. And the reason why that is because the way that the amount of interest we pay is calculated is that the 1% is multiplied by the outstanding mortgage balance, and then it's divided by the number, it's divided by 12 to get the monthly interest amount. But because we repay money off our mortgage each month, so it goes off the mortgage balance, the absolute amount of interest we pay varies each month. So having this standard repayment that we calculated before, it won't take account of the interest that's accruing. So you can see when we get to month 120, there's still £5,388 that's on the mortgage balance. So the question then comes is, well, how do we calculate a fixed repayment that lasts 120 months that's going to capture all this interest that we need to repay? Now, fortunately for us, there is a mathematical formula that will do that. So I'll just show you it here. So the payment is equal to this formula here. I was going to read it out there, but actually I'll just let you view it. But the variables that we've got on this formula, we've got R, which is the annual interest rate divided by 12. We've got P, which is the principal, so the starting balance of our mortgage, and N, which is the number of payments in total. So for example, if you have one mortgage payment a month for 25 years, then it's 25 times 12, which is 300. So that's what the formula is. And Excel actually has a built-in formula. So you don't have to type out this formula yourself. You just have to put in the PMT function. So it's a really, really nice formula that does the job. So what I'm going to do is I'm going to use this interest rate here and show you what the monthly mortgage should be. So if I do equals and I do PMT, and then the first thing we need to do is put in the rate, so that's our interest rate. So I'm going to put in the the 1%, but it has to be a monthly version of it. So the 1% represents an annual interest rate. So if I'll divide that by 12, I'll get my monthly version. NPER, which is my number of months, so that's 120. And then PV, which is present value, which is the mortgage balance. So that is £100,000. And then if I press enter on that, it will give me a value now of 876. Now that's automatically been put here in my calculator, and you can see, hopefully, fingers crossed, as I run down, it now should equal 0 when we get to the last month, 120, which it does. So you might be wondering, well, I'm just believing you. You haven't proved to us that this formula actually works. So what I've done is I've went to a mortgage provider online, and I've looked at what deal they would offer if I wanted a mortgage for £100,000 over 10 years. This scenario I've put in was having a 20 grand deposit, and the best rate they've given me is 5.78% with mortgage repayments of £1,099.19. So if my formula and calculator is working, if I put in 5.78%, 10 years, and £100,000, I should get this monthly repayment. So let's see, so 5.78%, £100,000, 10 years, £1,099.19. So yep, I validated it. I get exactly the same amount, and I should get to 0 as I scroll to the bottom there, which I do. So you might be wondering, well, that's all well and good, but how do you use it? Why is it useful? And the reason why I use it is because what I like to do is I like to do scenario planning. So I'm on a mortgage overpayment journey, and I'm on a very good fixed rate at the moment of 1.16%, but that fixed rate deal runs out in 2025. So, and by the time it runs out, I should have a mortgage balance of £100,000 or lower. So what I'd like to know is, I currently pay £509 per month for my mortgage, and I like to know, in terms of financial planning, if I go on to a higher interest rate, how much might my monthly payment jump to? So what I've done here is I've just calculated different scenarios. So some of the worst case, some of the best case of what my mortgage payment would be given different interest rates. So for example, a worst case scenario potentially would be an interest rate of 10%. So I've got my length of mortgage that I'll be left, which will be 20 years. So if I pop those values into the PMT function, it says that my mortgage monthly repayments would jump from £509 to £965. On the other hand, I've got a best case scenario, which is my interest rate goes to 1%, so actually below what it currently is, and putting in those values would give me a monthly repayment of £460. And then I've got some mid-range scenarios. So I personally think that I'll probably get a mortgage rate of 3 to 4% by 2025, hopefully, in which case I might be repaying £555 to £606. So a bit more expensive than what I pay now, but not too dramatically more expensive. So yeah, so that's just how I use the PMT function. I think it's really useful. But if you've got any questions about it, let me know in the comments below. And as always, subscribe to my channel if you want to see more videos like this. I post regularly about my own personal finance journey, so I'm regularly trying to save, invest, and overpay my mortgage with the aim of being financially free as soon as possible. So I'll leave it there, and I'll see you on the next video.